Okay, good morning, everybody, and welcome to the Pro Trader webinar today. Okay, good morning,
Hold on just a
everybody,
moment.
and welcome. All right, so we got the YouTube going and over in Discord as well. Today, well, this whole week, we've been focusing our Pro Trader webinar series that we usually do once per quarter, where we have professional traders come in every day, and they'll go through the way that they look at the market, how they're trading, what are their setups, and just insights from them. This has been an options focus webinar series this time, and would have been really looking forward to having Options Millionaire here finally do an event with us, and this is a perfect opportunity. So if you guys don't know who he is, well, Andrew began trading 11 years ago when he became intrigued with all things related to investing. The love of helping others intertwine with the accomplishing such a difficult task as trading brought him to where he is today. He's a volume profile analysis options trader with a strong emphasis on supply and demand. This is why Bookmap works so well with his trading style. He believes the best indicator is the market itself, and that is music to our ears as well. He has a YouTube channel here, his Twitter handle, and then also special offers from Bookmap. I'm going to post these into the chat, so if you guys are interested in following up more with Andrew or some special offers that are there, so you don't have to copy these down. I got to go through the disclosures, and then we'll turn it right over to Options Millionaire. General disclosure. All Bookmap limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. The risk disclosure: trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. All right, with all of that said, let's turn it over to Andrew and let him get started here. Go for it.
Good morning. Good morning. Yes. Yeah. Again, my name's Andrew with the Options Millionaire community. I appreciate the opportunity to come out. I'm always thrilled to work with Bookmap because for me, I am very selective with what I am introducing to my system. I'm someone who definitely believes that the market itself is the best indicator. It's the best way to manage your positions as well as sentiment in the market. And when I found Bookmap, and it fit perfectly into my system because it provides the liquidity tracker with order flow, and it's beautifully set up. So again, yeah, I'm a volume price analysis trader, which just basically means that I monitor the price action in the market relative to the volume, and I watch the inflows of outflows of volume and the relative to the price action to tell me sentiment. It gives me confidence in a particular trade, when to enter, when to exit, and obviously tying in Bookmap with liquidity is a perfect drop in and tie in to be able to do that. So again, I'm thrilled to be here, thrilled to speak with you all, and obviously work with Bruce and others at Bookmap. So it's a beautiful morning. So yesterday, obviously, everyone really saw that the FOMC, the effects on the FOMC, and the pure volatility of the market, and to be able to track the highs and lows of that volatility is crucial. And I think it's something we all strive for as options traders or investors in general. Is how do we make heads or tails of volatility like yesterday? And to be able to do the analysis on that price action and volume can tell you exactly what whens and whys. Whereas a lot of people focus a lot on indicators, the indicators don't tell you the whys; it just tells you the whats from 15, 20 minutes ago. So basically, yesterday the volatility was beautiful in response to obviously the FOMC coming out and hiking 75, and then today we've got the follow up. And basically, what I'm looking for today is the response to how the bulls are going to defend yesterday's key levels. 3,800 was a massive level. If you are looking at the stream, one of the things that's unique to my system is that I provide SR levels, support and resistance levels, to the community on the daily. And they provide a little insight to pivots in the market, where the market tends to bounce, where the market tends to reject. And we do that on the daily scale as well as the weekly/monthly scale. And they provide great insight to where the market likes to consolidate, reject, and bounce. So, obviously today you see the main level S3, which I'm kind of looking at on the stream here. This level, you can see there's indicated by a little bit of plus sign, and obviously it's a little bit brighter than the other levels. That indicates that that's a particularly strong level. And funnily enough, here is that there's also correlated with Bookmap here, where there's a lot of liquidity posted here at 3,700, even down to 3,767 and 3,760. And then, of course, we've been tracking this level for the past week, this 3,750 level, which has only gotten bigger and bigger and bigger. So they're providing a lot of interest and a lot more liquidity at this 3,750 level. In fact, it was like 400 and something, and now it's gone up to 800. And then now, of course, we see 1776. That is just getting larger and larger. So one of the ways I kind of drop in managing Bookmap into my system is not necessarily only the levels of Bookmap, but it's how the liquidity is managed. And that tells me a load of value right there, is that not only are they putting liquidity at certain levels, but how are they managing liquidity? Is it being taken off? Is it being added? If there's a lot more liquidity lower or higher, are they going to manage the liquidity up and down? And how they manage, how the larger money manages the liquidity is going to try to tell me something in the sentiment of the market. And if I can catch on to that and kind of ride their coattails, it's going to give me a great confidence trade. And that's basically what I'm trying to do today, is monitor all this stuff. And obviously, out of the gate, I was notating. I spent a few minutes in my server before heading over here. We were notating that most liquidity was posted substantially lower, even down to 3,750. There was a lot of block orders to the south. The CVD was inherently red. You see here, even the CVD is still incredibly red. And everything was posted much lower. We had a little bit of liquidity posted higher. So for me, the skew was definitely to the south. And then in coordination with that as well, we did see that pre-market lows was way down to the 3776 level. And when I'm tracking the prior day's lows and the overnight lows, which is down, I think ES printed overnight lows of 3767. So when I'm seeing the pre-market lows down at 3767, I'm going to be looking for, especially when liquidity is posted lower, I'm going to be looking for maybe an early test of that 3760 level to kind of wipe out the order book down for the pre-market. And then from there, to me, it's a waiting game. How are the bulls going to defend after yesterday? Are they going to defend at that pre-market level, or is this going to be another continuation down into the accumulation phase? So so big money can transact this lower and start accumulating at a lower price. So that's what I'm looking for today, is how are the buyers going to start defending at these key pivot levels lower, so they can start accumulation phase to start bidding the market back up. And we don't know if that's going to be today or if that's going to be later on. The fact that they did breach through many, many significant levels yesterday can tell me that there's a good chance that we could transact this lower before we start to enter that phase of bringing it back up. And then, of course, if that happens, we're toying with 52-week lows, which most likely will enter some sort of consolidation phase around that area. But overall today for me, I am looking for just watching how are they going to defend at these particular levels and try to take advantage of those moves when I see that. Obviously, right now, we have got, it is now 10:08, so we are, 38 minutes into the market here. Usually about now is when we start to carve out the morning highs and lows of the day, and I'm starting to try to play against those things. Obviously, if you see that we're kind of pinned to my S3 level, which is a significant level, so I am looking to see, are the bulls going to be able to transact this back up? Bring it back to Bookmap here. Still, they've got this 3820 level, which they put on a little bit after open. You can come back here and see that they started putting this a little bit after open. They threw on some 3820 here. But of course, other than that, everything is still very much lower, including the 3750. Of course, I want to zoom in a little bit here, and then the 3770, which is just below where we currently kind of bounced here with the bulls coming back in. So, usually I don't take too many trades the first 20 to 30 minutes a day normally, because I want to let the market kind of tell me where it wants to bounce and where it wants to reject. And most of the time I find that if I can remain patient in that 20 to 30 minute range, I can usually put on a good high confidence trade in the later half of the morning to take advantage and exploit what the market is telling me, which is where the liquidity is and where the highs and lows are. If you can be patient enough to let the market tell you where those are, then you can exploit those. You can exploit the highs and exploit the lows, at least for a good high confidence scalp, if not into a longer day trade if we are fortunate enough to get a trend up or a trend down. So beautiful stuff. That's just me. It's a dance between volume. When's the volume going to come in? When's the volume going to leave? Where's the price action going to bounce? So right now, for example, we have some buyers interest off of S4. We're coming back onto S3 again, which is our key level here. We came down to 3770, which if you see on Bookmap, we couldn't quite transact it. I saw them wipe out 3775 here They had some icebergs come in. They obviously had some stops to bring us a little bit lower. The CVD was very, very red, and it's still red, but not quite as bearish looking. But they weren't able to quite come down to transact 37.70, which was interesting for me because I am looking to see if this order flow will actually be able to come down here and then go on that maybe possibly a stop run or maybe a liquidity grab down there. But they were not able to do that. So if we do come on down, I'll be watching for 37.70 to see if they're going to pin and absorb, or if we're going to bounce back up for maybe possibly a double bottom scenario, and then maybe even come back up to S2 or S1, which is roughly about where we open for the day. So we're coming up on that decision time here. That was obviously a little bit of bounce off the low of the day. 37.66, which is ES, and of course I track ES for the main bread and butter of the market. Obviously, what you're looking here on the YouTube stream is SPY. You got SPY on top, NASDAQ in the middle, and then VIX on the bottom, which is SPY, NASDAQ, and VIX. But from a overall volume standpoint, I am tracking ES as well, because ES to me is what you want to be looking at for the larger players. In fact, that's why I track ES on Bookmap instead of SPY or other things, because that's going to tell me what the big players are doing. They're going to monitor their hedges with ES, as well as be able to manage the big liquidity on ES. So that's primarily why I track ES. So right now, it does look like we're going to come down for another test of the day's lows, at least getting close to it, which is 37.80, and then the low of the day right now is pinned at 37.72. And we'll see how we react when we come down there. And that's going to be, look, if I see maybe some sort of bottom wicks with the influx of buy volume there, which indicates the sellers are kind of exhausted here, we may have a refresh back up to high of the day. And that's what I want to try to exploit, is this lower level right here. Do I think we'll transact 37.50 today? I don't know. Right now, it looks like there's a decent probability with that amount of liquidity down there, but it really all depends on how they deal with pre-market lows. And that's kind of, for me, that's a line in the sand for me. If we can transact below the pre-market lows for ES, not SPY, by the way, for ES, because ES takes in the entire night. If we can transact through the pre-market lows, then that's a high probability we'll at least bid down to 37.50. So that's pretty much the first line in the sand, so to speak, that I'm looking for. 37.66.75 on ES. If we can close probably a 5-minute candle below that, then I will be looking for a move down to 37.50 at some point in time. But it's got to make that move here in the next, I would probably say 3-minute cycles, about 9 minutes, for me to be high confidence that we're going to put in 37.50. But until then, right now we're kind of figuring out here. Right now we are doing price discovery here at the S3 to see if we can negotiate the price higher and lower. Right now, the buyers and sellers are duking out that they're trying to figure out, is S3 market value or not. And so far, the bulls are trying to win this thing back up. So coming back, we've got 37.90, which is next liquidity here on Bookmap, 16 points up. And we got a little bit of green here coming up to 37.87. The three charts on the right, what you're seeing here is SPY is on top. You've got NASDAQ in the middle and the VIX in the bottom. That allows me to monitor both the S&P and the tech sector, NASDAQ sector as well. So those are a dance. They intertwine together right there. So we got up here off S3. Once we broke up here off of S3, I am taking a 37.90 call here on SPX off of this bounce off S3 right here. And basically what I'm doing with this particular position is I'm looking to see if we can even take out breach or even tap on S2, which is just above us here on SPY. So with this particular call, which I'm not looking to get too much out of here, I'm just trying to play the volatility as the upside as we break off S3. Can we get through S2? And then, of course, if we could break S2 and go to S1, this would be a nice little win for me right here, to see how strong we can get. Obviously, notice that you don't hear me talk too much about the EMAs. I do have the EMAs on my chart, but you notice I'm not talking too much about those, just because that's kind of a back-end indicator for me that I really only pay attention to on trend days. So coming up to the 34 here, that for me already is a pretty good win on that one big green candle here, and I'm going to go ahead and take some of these profits off, which is something I normally do. I don't usually let positions run the entirety of the position size. I usually scale out of positions to lock in profits and maintain profitability. So if there's that first touch right there off of S2, you notice we came up and touched S2, and now we've got that first little retracement off of that back on down. So now, that one touch S2 rejection, and if you look at Bookmap, which is right here, if you look at Bookmap here, we did have this nice touch of 37.90, which is right at S2. They grabbed that liquidity, and now we're kind of coming off here. They still have 37.70 on, and when we make a move like this, what I like to look for is how are they going to manage this liquidity now that especially now that we've transacted 37.95 or close to it. Are they going to add more liquidity back up and bring this continually higher, or is that pretty much it for the bulls? That was just a little pop up, maybe some short covering, and then we come off down. So this candle is particularly important on the 3-minute chart here, because this is going to tell me the true sentiment of the bulls. What are they planning on doing after this particular candle? So, and here it is right there, big old bottom wick. So that tells me there's still some interest there. The CVD is coming more and more neutral as we get a little bit higher, and we got 37.97 right there. So right now, 38.20 continues to grow a little bit larger there. They're adding this little bit of order flow into the book up here to 3,800, which 3,800, the 0 levels are usually always have some sort of interest. The computers, the traders love the 0 levels. 3,800, 3,700, 3,900. So there's always some sort of liquidity there. So when I'm seeing that, obviously, 3,800 usually is always, those levels always tend to be a good resistance or support. When I look at those, how are they going to manage those as well? Are they going to continue to manage that liquidity throughout the day, or is that going to be a stagnant level? Pre-market highs would be good. That would be a considerable run by the bulls. That would be nearly 50 points if we could get up to pre-market highs. So that would be a heck of a run here. Closed out about half that position size here, so just grabbing profits roughly 15-20%. And so that, once again, I think that's a smart move. Just a side note, I think it's a smart move. Anytime you take a position to remove some of that risk off the bat, to one, pay for the trade, control your emotions a little bit better, and make sure you can hold that position a little bit more accurately through the rest of that trade. So still holding this S2 rejection right there. NASDAQ is also coming off here. Looking at the NASDAQ percentages here, NASDAQ's a little bit more heavy than the S&P today. So NASDAQ's down about 0.9. And then S&P is down about 0.5. So there's about almost a 0.5% divergence, 0.4% divergence there, which is probably contributed to XLV and XLF. The financial sector and the healthcare sector are both pretty green relative to everything else, a little bit more strong. So it's causing a little bit higher prices in the S&P than the NASDAQ. So and the reason why I kind of track that divergence between the S&P and the NASDAQ is because I love to see, usually when we get a big, strong trend move, the markets are pretty correlated. Everything is kind of dropping and bouncing together when we get those strong trend days. So I want to look to see if there's any one that's kind of leading the other. And today, the NASDAQ is leading more heavy than the S&P. So what do we got here? Still maintaining this 8 EMA right here above S3. Not too much movement so far here. We have a little bit of bounce off 37.73 up to 37.94, which is a 21-point move. Until then, we're kind of figuring out right here at the 8. In terms of Bookmap here, 37.50 continues to be a large level. And then, of course, we got 37.70 there. So we're kind of in this open ether right here, where there's still a lot of liquidity, a lot of roadblocks down here, but the main stuff is definitely lower. A lot of orders are definitely spread out here. And of course, this is what coming on after yesterday. Obviously we're in a higher liquidity environment today and yesterday than we have been in a couple of weeks. We went through a couple of days where the order book was pretty light. The price was pretty choppy. We'd have some big breakout moves and then, 3-4 hours of chop. So from here, we're in a high liquidity environment relative to yesterday, today, as the book tries to digest what happened yesterday and figure out if we need to transact lower. And the great thing about tracking volume is that we don't know where the big players want to go. We don't know what levels they want to start their shakeout phase, where they want to start bidding the market back up. But we have to watch the volume and the price action to determine exactly when that is. They know it, we don't. And right now, it still seems like they want to transact this lower based on the price action we're seeing, unless we get a decent bottom wick with some volume on the daily chart. If I could see the buyers come in and kind of V-recover this thing into the last half of the day, then I'd be looking for maybe a move higher tomorrow, or maybe just another consolidation day into tomorrow.
So we have a question here, which I was wanted to ask as well about your decisions on strike prices, deltas, etc. Like just kind of in brief, like no, we I know you went long with your call, but how do you kind of choose your options?
Yeah, great question. Great question. So, over the course of years, I've kind of refined my process where I kind of based all my decisions based on a certain delta. I've experimented with many different, especially with day trading and scalping. I've experimented with many different items like 5 DTE all the way down to 0 DTE. And usually, before all the volatility crazy kickoff of 2021 and 22, I was looking in the ballpark of about 0.35 to zero point 0.4 delta, which put me in the ballpark on a 2 DTE to 0, anywhere between 10 to 20 points outside the money on SPX. And that was a good risk reward for me. And some people it's different. Some people want to be a little more conservative, play in the money contracts. They want to play longer expirations, which is obviously an individual preference. But that put me in the ballpark of risk return. It put me a little bit outside the money, where if I caught a good 10 point, 30 point swing on the index, that it would give me a great return. Where the in the money didn't quite pay as well. So the deltas is something I look at right now. I've kind of refined the process so much that I don't even look at the deltas now when I'm looking. I'm just looking at the ballpark of 10 to 15 points outside the money when I'm taking a transaction. The little later in the day is when I start pulling that back a little bit. I start going closer to the money, or at the money, or even in the money in the later half of the day, just take off risk. And then, of course, I start extending my expirations into 1, 2, 3 DTE. Now, that's just basically the scalping stuff. For the longer term stuff, like the 3-week, maybe to the month and a half stuff, swing stuff that I trade, I tried, the common term that I talk about is I want to take a strike that's realistic but aggressive. So when a lot of people talk about taking a swing position, for if they're expecting, let's say, a 500 point drop, if we're at 4,000 and someone's expecting the market to go to 3,500 by November, which is a 500 point move, I don't want to take a put with a 3,500 strike. I want to take something that the market has a reasonable chance of getting in the money and then actually building a position into the money so you could take advantage of the gamma spike, which is, I notate it as aggressive yet realistic. So, and to me, that's really the only way I can figure that out is based on current pivot levels and the analysis I do on the charts. If that's going to tell me, well, the market could get to 3,500 by November, but I want to take something that's a little bit higher, maybe 3,700, that's halfway in between, where we can get that big gamma spike, which is precisely what I did back in June. That paid an enormous amount just because the position was actually be able to go in the money and then about 200 points into the money, which paid well. So my thesis on choosing strikes is different based on the day trades and the longer term stuff. So it's primarily delta driven on the shorter term stuff, and the longer term stuff is really based on analysis on the charts.
So, and then how far out do you go on the longer term?
Longer term stuff, normally, if I'm doing about 2 to 3 week charts, I'd like to stay in the ballpark of about 100 points in this environment. Of course, 2022 is different. We're getting frequent, 100, 400 point swings. So I'm being a little more aggressive in 2022. In a normal environment, it's a lot closer, maybe 50, 60 points in a normal environment for a swing trade that's primarily farther out. But in this environment here, I'm finding myself going the ballpark of about 100 to 200 points. Back in June, I went 500 points out, and I caught it just at the right time, and we made a killing. But again, I'm taking advantage. I like to make hay while the sun's shining. In 2022, the sun's shining in terms of volatility. In my opinion, 2022 has been an absolute feast for option traders. Like, this is as good as it gets in terms of volatility, because we like to take advantage of volatility as long as your timing is correct, of course. So I'm being a little more aggressive with my strikes this year, and I'm taking stuff that's a little further outside the money for swing plays, because if you can catch a run, then you can make some good money.
Yeah, interesting. So, and then what about in terms of calendar?
Calendar. So I find most of the stuff I've been taking is about a month out. I would say the highest number of swing trades I'm taking is about 4 weeks out, 4 to 5 weeks, because that enables me to with the market cycling in about a 5 week period. It's very difficult to hold a swing trade longer than a strike that's that far out because we're getting 500-point sell-offs and 500-point buy-ups, and that's just the nature of a bear market. We keep getting the bear market rallies as we oscillate between accumulation and distribution. So for me personally, I'd like to, in this environment, I'm trying to keep all my strikes within about a 4 to 5 week range so I can plan those cycles. And then once we kind of break out of that or we enter back into a bull market, then I'm going to start building in more 6 month positions, 5 month positions, maybe even some longer leaps.
I see. So
In
you're playing the volatility like that, and the swings are the swing trading. Then you're really only looking for holding for like a few days or so.
Absolutely, yes, absolutely, absolutely. So, for me, I am really trying to focus on identifying the accumulation and distribution phases of the market, and they're starting to happen faster and faster. Usually, we usually, because accumulation and distribution, if you're not familiar with VPA, accumulation and distribution is the break between accumulation, which is where large players want to accumulate shares lower, so they can start to bid the market up and transact them and execute them higher or distribute them to other players at a higher price. And that cycle, usually you get, a big sell-off, and then you get about, in 7 to 10 trading sessions of consolidation or shakeout phase, and then they bid the market back up and they transact those prices higher. Well, it's starting to become faster and faster with the volatility, especially as we get closer to quantitative tightening and rate hikes in the economy and the recession. Those cycles are starting having faster and faster. So we have to start planning those swing trades a lot quicker. Whereas normally I'm trying to enter those swing trades at the last half of the shakeout phase. Now we're trying to be like, all right, well, like we only had this prior before FOMC, we only had like 3 days of consolidation before this big move down. So you got to plan those things a lot quicker, which requires a lot more emphasis on trading analysis on the charts, and then obviously planning your entries because, as we all know, with options trading, timing is everything.
Okay. Okay. Great. So let's see. Uh, David, did we answer all your questions there? If there's anything more that in details here, since we've got Options Millionaire right here. I was kind of wondering about so the day trading. You're also is it basically is the current month that you're also looking for, like 4 or 5 weeks out or something like that, or is it what's the calendar on the day trades?
Yeah, so the day trades, I've like again, 2022, I'm trading differently than I have been just because I'm being more aggressive. So primarily now, I'm scalping zero DTE trades, and then for the later half of the days when I take longer trades, I'm going a little bit longer on those DTs. But primarily now, I'm scalping or day trading the zeros. But I try to be one. It's my position sizing also is changing, which is a big tenet of my system. Is that the more aggressive I am with the zeros, zero DTs and scalping, the lower my position sizing are. I don't do large position sizing, and then of course the more confidence, the longer term stuff is why my position sizing goes up. But in terms of zeros, yeah, the scalping is usually zeros, one DTEs, depending on the ticker I'm trading. Sometimes it's Apple, Amazon, or Microsoft. Most of the time though, it's the S&P.
Okay, excellent, excellent. And then just kind of curious about how you're managing this current position here.
This current position here, I am watching S3. S3 is a significant level, obviously, and that's my line in the sand. I've took profits on half the position up at S2, which was for me. I'm paying for that trade. So basically, now I've got a risk-off trade for the last half, and it allows me to be a little more patient here off of S3. So if I can get this thing to bounce off S3 and maybe even head up to S1, which if you're looking at my chart would be roughly a point and a half on S&P on the SPY. As well as what I'm seeing here on Bookmap here is we got a little bit of liquidity back at 37.90, which is also kind of where we rejected. That would put me in a good position to take some profits here. And of course, we're bidding back up to S3. But if really highlighting position size management here is that when I took the initial trade, I was fortunate enough to get a good run. I closed out half. And that does two things. It releases a lot of pressure on my emotions to manage the trade if this does break down like it did, 3 candles. And 2, it allows me to hold the position into profitability because you manage a position differently when you're profitable than you do when you're in the loss. So allowing this position to maintain profitability allows me to be a little bit more headstrong and calm when I'm managing those 3 candles. So when I see those 3 red candles show up a couple of minutes ago, I'm like, all right, well, I've got half the trade left. If S3 breaks and closes below, then I'm probably going to look at exiting that trade. which probably would have been a loss on the last half, but almost a wash on the overall position. Fortunately enough, here I'm able to be patient enough to see a couple of bounces here. We're back into profitability, and I'm looking to see if we can carry this up to S2. And if we do break down and have a double test of S3, I'll probably just go ahead and execute the sale of the entire position. But that's pretty much it. My whole strategy on the day trading stuff, and of course there's different strategies for different positions, but my day trade strategy and my scalping strategy is playing level to level. It's monitoring the liquidity in the Bookmap to kind of tie into my SR levels, so I can identify levels at which to play calls low and puts high. Obviously, that's what I'm looking to do. And what the SR levels allow me to do, what Bookmap allows me to do, is identify levels of interest, whether it be supply or demand, so I can make sure I want to be taking calls on demand and puts on supply. Because a lot of people try to play breakout trades or breakdown trades, and those trades fail about 80% of the time. Is where you try to get a breakout, you actually do maybe get a candle breakout, and then it reverses into that supply zone and comes back down, or bounces off demand and comes back up. And that's what we're really looking for, is they will identify those zones where I could pivot off of and really exploit those areas.
No, that's a great insight there. I mean, like, I'm wondering also too. So, I mean, are you? I mean, with options with a zero DTE. I mean, are you looking at some of the Greeks in there, or implied volatility, or anything like this? Or I mean, because it just seems like such a natural thing. Once it starts to hit in some of that high liquidity, a lot of people don't see that, and that's where you're going to get an advantage.
Yes, in terms of planning, a lot of the Greek analysis for me comes into the pre-market, because when I sit down on my computer every morning and I start doing my market analysis, one of the first things I open up is a blank ES chart and the options chain. And I start to dig into the Greeks. I start to look at mainly the implied volatility. Although the implied volatility is not, I guess, not technically a Greek, I still think it's incredibly important, especially in this market where Powell's coming out and talking, and CPI and all the other stuff. We saw IV go up to like almost 150% yesterday. Nice little bottom wick by off S3, by the way. So, the Greeks, I pay attention to Theta a lot and Delta. Those are the two main ones I'm talking about. I really look forward to. And I think it's more important to understand like gamma levels, because gamma is such a huge part of us as options traders and what happens, especially when you go in the money. I think it's very important to understand. But in terms of values, the implied volatility or the deltas are the two I'm looking at, because obviously the deltas, we can kind of look at how the market is positioned and how the market, how the sentiment in the market really is positioned, whether or not you think, the market's pricing in a move higher or the market is pricing in a move lower. Because if we think about options in general, what are options? Options are insurance. Their options are intended to they're derivatives. They're intended to hedge other positions for a big money standpoint, because we have to think about how the big money plays options. All right, we got to move up to 34 here. So just a little side note here. If we come up to S2, I'll probably look at it either scaling out another porta position or closing the position altogether based on the weakness of the buyers here. But that was a good influx of buy volume, some decent price action, bottom wick off S3, which is pretty bullish, and coming up to S2. So, the delta and the implied volatility, in my opinion, are the two most important data points on the options chain when I'm doing those type of calls or with those type of positions.
Okay, and that's all pre-market. But then once you've got that all set up, you basically know what you're going to be trading, and then just you're looking to aggressively get in.
Precisely, yeah, precisely. And then if I see a big volatile event come on, maybe like a news event drops or something like that, something we didn't necessarily anticipate, I'll go back into the chain and I'll start doing a little more analysis and figure out how it's going to adapt the order flow, how it's going to adapt the IV. For example, yesterday I was heavily dependent on looking at the IV, managing positions with that huge move, because I want to see when did they start. You can really identify when the real move is being made in the market when IV starts coming off. So for like yesterday, the IV was still jacked until J Powell pretty much stopped talking, and then IV went from like 138% and just smashed. So you can identify when the quote unquote real move is being made by just monitoring implied volatility.
That's fascinating.
So one of my channels, literally throughout the day, I was posting updates on implied volatility just to really highlight how that happens. 41%, 57%, 97%, 102%, and it went up and up and up and up. And then it maintained throughout his speech, and then it started coming off a little bit, and then once he stopped talking, IV smashed, and then we made that like 120-point move down from the day's highs.
I mean, do you ever? I mean, like you said, it's all timing here, and
Sure.
but maybe you get caught up in kind of a distribution or accumulation pattern, and maybe your IV or your delta reading was fine, but the theta starts to you get your time decay. Um, how do you kind of balance that out?
Yeah. So yeah, obviously Theta is our worst enemy of options buying. Obviously, selling is a different story, but options buying, Theta is a big one. So I try to work in cycles. I monitor the 3-minute, 5-minute, 15-minute chart primarily on the day trading, and even go up to the 30-minute. In my opinion, 30 minutes is my favorite chart to trade off of and monitor. But when I'm on the charts and I can identify when we start entering into the consolidation zones, that's when I really want to hold positions quickly or exit positions quickly. I don't want to hold through a lot of short-term options expirations through that consolidation, because I want my delta to overcome my theta, obviously. So when I start to see those data values start to really juice up, especially in the later halves of the days, I'm not interested in being in a position too long or even trading that in general. For me, I'm trying to hit big trades 3 or 4 times a quarter, or maybe even 3 or 4 times a month, and then pretty much everything else is just onesies and twosies, small stuff. That's what I'm trying to do. So if I see a low confidence area like a consolidation before in between the moves, and theta is starting to get jacked, and we're starting to really degrade the positions, it's not something I necessarily want to be aware of, be involved in, because that is a low probability, and it's all about managing probabilities at option traders. Instead of fighting the chop, instead of fighting the consolidation, I want to hold off until I see a big move like yesterday. And everyone who's in my server and follows me knows that I get very excited for CPI and FOMC, because it's if you know how to position yourself properly. I mean, it's like the Super Bowl for option traders. It's the best way to make money, to even make a month goal in one day, playing conservatively even. So when I see those areas of consolidation, I automatically back off. I kind of step back and like, well, do I need to be trading this consolidation? What I'm looking at the theta values, or theta is theta overcoming all the deltas just because the delta decay, just because of what we have here on the consolidation of the market. So yeah, theta is very important. Especially understanding how to manage theta and how to interpret what happens as we get closer to the end of the day, especially if we're in a consolidation phase, because the most aggravating part about options trading is that you can be right on your analysis and still lose money because the position doesn't move fast enough to overcome that theta value.
Right, it's just maddening about options. The underlying moved the correct way, everything moved, and you still lose money on it.
Oh yeah, yeah.
Uh,
It's
yeah, I'm just wondering then, like how. So you're watching the two for the day, and maybe you kind of would you consider like exiting a position just because the theta is starting to, it's in a consolidation period, or maybe this revolves more around your holding time for the day trading.
yes. So when I execute a position or enter a trade, I basically form a thesis, and I draw lines in the sand. I tell myself, well, if it breaks down below here, I'm out. I don't care when I'm scalping or day trading. I'm looking at a certain. I'm basically my entries and exits based on the charts rather than kind of like my P&L. Like I don't want to say where I had 10% loss, I'm out, because especially when you're dealing with shorter expiration options, you're going to get chopped up. You're going to take a ton of losses doing that, because a shorter dated option goes 10% loss all the time. So I want to take my trades based on the lines on the chart, based on, all right, well, if it breaks, like for this example, if it breaks down below S3, I want to close out. And then I'm going to manage a position upwards if we break up to S2. And then that allows me to really look at something. Now, the second variable I need to tie into that is time. I'm going to give myself a time where, like right now, for example, I'm not going to hold this particular call until like 2 o'clock if we're going to sit here and chop between S2 and S3, because the position will get destroyed. So I'm going to give myself a couple of cycles, because the market works in cycles in terms of time cycles. So on the 3-minute chart, I'll probably give this to probably 10:45, and then if I don't have a move made above S2 or S3, I'm going to go ahead and close out the position, because then the move on a 0 DT option has to move so far in order to become profitable that the odds start stacking against me, and that's all it is managing the odds. what are the odds that I'm going to be able to break up? Because the longer we sit here at 37.84 on ES, the higher and higher my break-even point on the remainder of the trade gets because of theta. So, and what does that mean for my probabilities? That doesn't bode well for profitability. So I usually give myself two areas of criteria to exit and enter. One, levels high and low, where I'm going to say, all right, well, if and statement, if it breaks below, I'm exiting. If it goes over, I'm going to scale out or manage. And then the second variable is time. At what time am I going to get out? Now, there's sometimes that time is a little bit shorter or longer depending on how aggressive theta is on the particular day. If theta if it's a tough theta day, or if we're in the last half of the day, for example, where theta really starts eating up positions, then I'm going to look at, well, I need to give it less time. I need to, I'm not going to let this position breathe too long because theta is going to be too aggressive. Anyone who's traded 0DT contracts in the last hour of the day, which in my opinion is pretty much gambling, knows how aggressive theta can actually be. That's why you don't do that stuff in the later half of the day. You only do that earlier on in the day. But managing the theta and understanding theta is a huge point, which I think if you're going to be an option trader, you need to become well versed in both the management of theta and delta to understand how to manage your positions.
Yeah, I mean, that just really adds another complexity to the trading here. Tremendous. Now your exit criteria is not just based on price.
Yep, absolutely. Absolutely. So, I try to make it a habit of not to execute trades based on my P&L or based on the price of the premiums, because that's going to put me in a position of chasing my P&L. And when you start doing that, people freak out when they see their P&L go red. And and all you have to do is, wait out a little bit, be a little patient, let the price action go. And you could be right. You're a little too impatient. You're closing out for a 10% loss, which sometimes you need to do that. But I'm personally trying to manage my positions based on what I'm seeing with the data. If I enter a call here and this thing starts getting super bearish, if the flow starts getting bearish, which is looking like it might, I want to exit a position based on, I don't want to exit just because I'm 10% loss or 5% loss on my P&L.
So then how do you manage your kind of account management or trade management in terms of P&L?
Well, for me personally, obviously you want to. It's really buying. It's playing level to level for me. Obviously, like when my P&L really comes into to scaling out of trades. So for me, I want to always scale out. Very rarely do I take a trade and hold the entire position into like maybe 100% profit. Let's say I'm always scaling out, and that puts me in a position of being safe. And because I want to drive consistently. Consistency to me is the number one priority. If I'm not consistent, then I'm not going to be able to generate profits. So in order to be consistent, I need to be able to manage position, and especially even scaling out. That's why I always scale out on upsides. That's why on the downsides, I'm setting a line in the sand where, like, if we close under S3 like in this example, I'm closing out the position like I'm pretty much about to do. XLF is starting to break down here, so if we close this candle here, I'll execute the rest of the trade.
Just a massive iceberg there got filled.
Yeah, 25.51, colossal. So, and the reason why, because that pretty much does the work for me on my P&L, because if I'm sitting there watching my P&L like a hawk and saying, all right, well, if we break 10% red, I'm closing, what that does is it removes your chart analysis, because you could be exiting a call here right before we get a big bounce. And you're like, well, I just sold a call right before it bounced. Well, it's because you're selling your position. You might have just an unfortunate 10-minute early entry where you were just, we're about to bounce off demand and go higher. So yes, I do watch my P&L, but I'm not necessarily making my decision based strictly because I'm like down 10% or something.
Yeah, understood. Just a lot of moving pieces here.
Oh yeah. Yeah, so see here we're this S3 here, we're holding it all morning long. We came down and touched it, slight breach below, and we're just been pinned right above our S3 all day, which is on SPY 375.06, and most liquidity is still very much lower here. So that was a massive one. I saw a very large iceberg a couple of days ago that we notated that was very, very large. And I'm starting to see more of those as the volatility ticks up. I'm starting to see more and more of these icebergs and larger stops as we get deeper into this volatility. All right, so we got XLF just breached their low of the day, which is the financial sector of the S&P. Google looks like it's kind of fizzling out here at their highs of the day, and everything else is pretty much flat and chopping. Tesla's getting destroyed today. If you notice, Tesla's down, man, Tesla's really getting destroyed. Tesla's down 3% on the day. They're down to 291 and continuing to fall, which is they're 12 points off their high of the day. So a little bit of red is definitely starting to creep more and more in here. I'm curious to see how Google's going to react, and XLF, which is the financial sector, is going to react here as they're kind of putting a new low of the day. Because for me, I monitor 10 different sectors of the S&P. If you notice on the screen there to the right, I've got sectors of SPY on the YouTube, and I've got them in order of highest to lowest allocation for the S&P, and that allows me to pretty much do a litmus test of the market. So if I see the S&P making a move, I want to click through those X sectors to figure out which ones are doing it. Are the largest players of S&P moving, or are they not? And that allows me to develop confidence in a particular up or down move of the S&P. So like for right now, I'm monitoring XLF on another chart that you can't see, and they just put a low of the day in, and promptly we'd had this little green candle off S3. So I want to monitor that. If XLF continues to sell off, it's going to be difficult for the S&P to climb back up, because one of their sectors of main sectors, financial sector, the banks are getting destroyed. And that's what I want to monitor.
So I mean, so it appears like all in with the position and then scaling out.
Yes, yeah. So I very rarely hold an entire position the entirety of the trade. I'm always scaling out. I think it's a good practice. Sometimes, most of the time, that first trade, my intent, I'm about to execute the remainder of this trade. My intent for a scale out is to pay for the trade, to take risk off the table and allow me to hold the remainder of the trade. And sometimes I get 200-300%. Sometimes it's 60%. Sometimes it turns into a loss on the remainder half of the trade. Either way, it allows me to lock in profits and basically take risk off and have a risk-free trade for the remainder of the trade. So, but yeah, always scale out for me. It's always something I think is a good practice to do. Something I developed, started doing a while ago, and it's a good driver of consistency.
That's
because
go ahead. Sorry.
Yeah, one of the more common questions I get is, how do you hold a position to 100%? Like, I always take profits way too quick. I was like, well, yeah, because you're dealing with your emotions. And to me, emotions are the most important part of all of this. How do you manage when you're in the trade and your heart's beating fast and you see that big green spike if you're in a call? It's like, how do you manage a trade to 200%? And there's no real answer. There's no real good answer. Obviously, you could do some technical analysis on, does it go up? But sometimes that fails and comes back down. But the real answer is, you got to start managing the position in a smart way to remove that emotion. And the best answer I've found is just to scale out, take profits off early, pay for the trade, and then leave half the position on for 200%, or leave a quarter position on it. You're still getting great money. You're still making a great trade. And you're able to manage the position more clearly instead of freaking out all the time and think, well, this position could reverse and I lose all my money. So, managing the position, managing your emotions, I think is just as, if not more, way more important than knowing the data of the market too.
So, I mean, since you're managing it off of the chart, which is great, it keeps the emotions low. But how do you know, like, my overall, for example, might be at a loss right now, even though I've scaled out?
Yeah. I still monitor that stuff. I just try to make sure I'm not making necessarily decisions based on that. Obviously, if obviously that comes with experience too. And if I see a position really starting to degrade into my profits, I want to look for, why is that happening? I want to look for the why. And if I don't know a why, then I'm probably going to get out. Or if I see, all right, well, yes, I'm going to call, but things are still looking significantly bearish, then I probably want to get out. And that allows me. And I'm still tracking my P&L. I'm still watching things. If I hit my daily goal, I'm more apt to close out positions just so I can secure that number and then kind of like take hands off for the day and go smaller position sizing. But it's really about managing that stuff once the position is closed, or once things are really kind of screaming out of the charts for me.
It's a great way to manage your emotions there.
Yep. I'm a big proponent of emotions. I have a podcast that I talk a lot about basically that side of thing. My YouTube channel is reserved for like the technical, academic, educational stuff, and my podcast is made for managing the mental side of investing and emotions and financial independence. And that's a huge part. It's people don't really talk that much about managing the emotional side of trades and how to really stay calm in a good or a bad trade to kind of see what the market, for what it's really doing.
Yeah, great stuff. David was asked, I think you answered this, but the in the monies, do you also go in the monies for the 0 day?
I do.
Okay.
I do. So the later in the day we go, I start going closer and closer to the money. Or if my confidence in a position is not really where it should be, I'll go closer to the money, if not in the money. Especially if I elect to do zeros in the last hour or two of the day, which is very very rare, I'll go in the money. Then after that, obviously, your next option would be go to extend the expirations. So you got to be you got to be very delicate playing zeros on the last half of the day, and I try to do everything I can to mitigate risk for that, or just absolutely, or even then extending my expirations.
Okay. And then also, do you ever add to a position?
Rarely, rarely. That's something that I really have to have good confidence because averaging down on a position on options is it's a bad habit to get into. It's a good way to kind of wreck a position. Whereas sometimes it's definitely appropriate and it would work out in your benefit, but averaging down I'll average down on a stock all day long, but on an option it's difficult because obviously option if it expires outside the money, it's you lose everything. So you got to be very delicate with doing that for me.
Okay, excellent. So high probability move is what you're looking for, and then just managing it.
Absolutely. Yep. High probability. That's what I'm trying to do. Is that my position sizing adjusts with that high probability. The more high probability setup I see, the larger position size I'll take, and vice versa. And that probability is based on a confidence in a pivot, or even the levels of Bookmap. How much liquidity are we dealing with? Is there a high liquidity environment? Do I have a strong level we're necessarily playing at, which allows me to drive my confidence?
Yeah, understood. Excellent.
Man, we got 37.7. That's got a large liquidity popping up here, even down to 37.60. So what I'm seeing here is that they're managing this liquidity lower. You see this 37.75 that they're kind of grinding up on it now. We've got this 37.60, which is being managed, and they continue to add this 37.50 level, which, like I said, that's been on my radar for about a week now. So before FOMC kind of kicked off and we were still at higher prices, we notated this 37.50 level. And we're thinking like, well, is this their target? Is this what we're looking for after FOMC? And that's why we saw this big move down in, obviously the past 24 hours. And it's like, man, that seems to be their target because we saw that liquidity being put on. And for me, I get pretty excited when I see Bookmap start to really shine its light on a particular area. We have large ranges of liquidity being put on that's maybe far outside the money. That starts to get my heartbeat, my heart racing a little bit. So I'm like, all right, well, is this market ready to make a move or break out of consolidation, break down, and break up? So I'd love to see when they're starting actively managing liquidity that's far away from these strikes because it gives us a good area, a good indication of where this thing might go.
Yeah, that's great. I mean, that's yeah, I always feel like having access to liquidity is such an edge.
Oh, absolutely. Yeah, it's a complete edge. And I'm very selective with the tools I add to my system. I test out and discard a lot of stuff, but I was very intrigued and driven to Bookmap based on just managing this live liquidity. I think it's a beautiful tool. $37.74 here, coming down to test low of the day again, which is S4. We've kind of finally separated from S3 and closed below. We have got 37.70 here, which is that next level of liquidity that looks like they might try to transact here as they're kind of bidding this thing down. It's starting to get a little more aggressive. You see that price action starts to get a little more aggressive, rounding off to the bottom. It looks like they want that 37.50 exactly. Yeah, and so I'm very curious to see how they're going to react to 37.70 plus the 37.66 is a level to pay attention to as well. That's the pre-market lows, and when those computers put in those lows in the overnight hours, it's something I want to pay attention to and mark because that's obviously a level of significance, and we usually get at least some sort of checkup around those levels and allow you to be a little safety or to kind of draw a line in the sand with the market. Well, if it wipes out that level, which is what I'm looking for, if we could put in another low of the day here as well as wipe out that pre-market low, are we going to be able to make a move down to 37.50? Do I use Bookmap to look for entries, exits, or both? I look for them for both, and it helps me do both. It really helps me on my exits, though. The exits allow me to hold positions for longer to gain more profitability, too, because if I can see that the liquidity is skewed to one side or the other and I'm in that directional trade, it's really going to help me give me that confidence which again, a confidence driver to hold on a position for a longer time. So you can kind of see as we come on down and approach the low of the day, we're getting these smaller and smaller candles and a little bit less participation as we come down here. So what I'm looking for here is a spike in volume. You can see the volume's dropping off here as we're coming on down. I'd like to see a spike in volume and in participation to transact this level, which looks like we're getting now under 3770, which could give high confidence that we'll transact down to 3760 and then make our way to 3750. All right, here. So, for me now, it's like, for example, the strikes I'm looking at now, if we were to breach this 3772 level, which you have to be delicate with it because that is a decent bounce area off of the low of the day. It's different. You want to be very careful taking a breakdown trade through lows of the day because we get like that candle right there, that little bottom wick. And you see we bounced right off S4, which is pretty much tied to low of the day, down to the penny. We bounced off of it, moved it a little higher, and coming back up. So you got to be careful taking a breakdown trade through lows of the day. And conversely, you got to be careful taking a breakout trade at highs of the day because usually, even if it's a trend up or trend down, we at least get a check up there. And you might be able to get a better entry, you might be a little more patient, and then waiting for the kind of shakeout at these particular levels at low of the day and high of the day. And plus, now we got this liquidity that's just below lows of the day. We're going to see if we can try to grab that. And then obviously work our way down. And I want to see how the volume comes in as we get lower and lower. How active are they going to be? Obviously, the flow is very red at the moment as we kind of bid this thing down about 15 points.
Some really
On
odd
37.7.
icebergs in there as well, like that one on the offer just following, the blue line there, the squiggly blue line, and then one on the bid there for 5.
Yeah, notice that. I'm trying to see, how they're going to really bid this down, especially after that very large the order flow that came in earlier. I want to see if they can really start hitting this thing because they're kind of trickling this thing down. And if we get a momentum pop through this little the low of the day, which it's getting closer and closer, it could be pretty volatile. At least in the short term, to kind of like that explosion through as the orders come through and blast that through that demand zone, and start smoking us down to 3750, which is quite a large level.
Yeah, yeah.
So I love the SVP here too. It's something that I've added more recently, and volume profile is a huge part of my system that I follow. But adding the SVP onto the Bookmap was huge too, because it allows me to monitor the POC, which is an awesome level to manage the price action around. Adding these things here gives me a little more insight into where the market might be drawn to. So if we bounce up here, then I'm going to be looking in that ballpark of 3780, which is right at S3. 3780 to see if we're going to consolidate around there again before another move down. But for first of all, we've got to see how this works to your low of the day. Yeah, so when I'm doing my, time frame continuity is a huge part as well. So when I'm on the 3-minute chart, I execute basically on the 3-minute, but I do my analysis on the 5, 15, and then even out to the 30 and 60, 30-minute being my favorite. The 30-minute is going to paint you the overall picture of what's really happening, and it cuts out all the shorter time frame noise that'll, get you in trouble if you're following the shorter time frame stuff. So like the 30-minute now shows a clear top wick after a pretty large doji at S3. We've got a large top wick down to the low of the day. Still a drop off in volume, but overall the sellers are maintaining decent volume. On the 15-minute, I think we just put in a new low of the day right there. Yep, right there, new low of the day coming on down. And a flusheroni right there. So looking for how they're going to react here. As at 37.69, they just absorbed that large level at 37.70. And let's see how they managed that. So that was a nice blast through, took out that level, and now we're looking for lower, maybe 37.67, which would even put us on the track to 37.50, which would be beautiful. Okay. So 37.66 is low of the day. And I've got that notated on another chart here because that's something I always want to track is that low of the day chart. That low of the day is going to be crucial for managing potential bounces. Yep, Bookmap never lies, man. It's awesome. It's like every time I question liquidity on Bookmap, it always proves me wrong. So it's always good stuff. I love it. So not quite getting down there. Not quite getting down to 37.66. They got that little liquidity just came in 67. 66.75 is low, and there's a nice little bounce right off of it. So if you manage the VIX here too, the VIX is up 0.86, which is pretty. It's pretty suppressed given the fact that we're down, 36%. Obviously, things are happening a little bit slower. The VIX is obviously acting a little bit wonky this year compared to other years. I know a lot of people are talking about, the VIX hasn't even seen 40 yet, which I think it's coming. But yeah, the VIX is another part of the system I haven't really talked about today, but it's a huge part. Managing the VIX and the volatility is a huge part of sentiment in the market and kind of judging where things are kind of going to go. And it's been a little more difficult this year because of the way that the VIX has been kind of suppressed going into these large moves. So let's see if we can hold this candle right here.
So are you using the VIX in your pre-market just to get a feel for, some of the implied volatility in the options?
Yes, I do. Yeah, the VIX is one of the things I look at in my pre-market because I'm wanting to really see how the market is absorbing volatility or selling volatility. If you remember back in June and July, we were in a selling volatility environment where they just sold all volatility, and of course we had that huge price pop up to high prices. So that's something I want to watch. If they're in a because I remember I took some long VIX calls way back in May and June, and when I started to see that environment really start to spike, that after they're selling all volatility no matter what the price action was, is when I elected to close those calls because to me when they start doing that, I don't want to be a part of VIX calls. You got to be very delicate, especially playing options on the VIX. But when they start managing that VIX like that, and things start getting bullish on the charts and then negative on the VIX, you got to pay attention to that because that's going to tell you, all right, well, if they're going to just sell volatility every day, then I'm going to start taking calls in the S&P because they might drive this higher. So I don't do any technical analysis on the VIX, obviously, because I don't think that's something you can do. But I do manage the pivots on the VIX where they start to enter phases where they sell volatility or buy volatility. And if I can if I can really identify those zones, then it can kind of give me good sentiment where they might spike the S&P or sell off the S&P.
Are there other, in general, like, are you usually just, trading on the indexes here, or is it other stocks, individual stocks, different commodities?
For an option standpoint, I mainly trade on the SPX. I do ES futures, SPX options. A lot of people, or the S&P, because a lot of the members in the server are doing SPY as well. But I'm doing SPX and ES. And sometimes I'll break out, like an earnings trade, for example. I do a lot of Amazon trades. We recently did an Apple put. We do a lot of different stuff based on the top 10 of the S&P. But I don't stray outside of the top 5 or 6 holdings of the S&P, like Apple, Microsoft, Amazon, Tesla, Google. I pretty much stay in those bounds, unless it's a special event like an earnings play, which I don't do very many of, or something like that. Otherwise, I'll stick with the options. Now, from a stock standpoint, in my stock account, I do pretty much I do a lot of different stuff. I'm well diverse in long-term holdings and stocks, but those are mainly for investment purposes, not for like day trading purposes.
Right.
Just because I believe in being a master of one instead of trying to scramble to kind of get a hold of everything. I want to focus on the S&P, and it's treating me very well. So here's the low of the day. Here's the pre-market low test here coming up, 37.66.75. Just wiped that liquidity there. Oh, did they actually wipe it? Oh, they didn't transact that one yet, it looks like. And 37.60 is getting a little robust too. Where's that iceberg at? So they put on some decent icebergs there. Look at that large iceberg right there as well. Over 1,000. And just like that, down to the penny almost, they bounce right off that pre-market low. So Yeah, so that low of the price right there in ES was 37.67. Low of the day, and pre-market low there was 66.75. So with 25 cents off there on the ES. Those to give you a little protection. I try to identify those main pivots in the market. It gives me protection. It keeps me from trying to play a put on the breakdown and getting bounced on right at these key levels that some people don't even know they're there, and they wonder why they just took a call or took a put at the bottom.
I'm just kind of curious also in kind of your evolution as a trader. I know we know you're looking at calls and puts here,
Mhm.
and but did you or do you still do like different types of spreads, calendar spreads, vertical spreads, all sorts of other things in options?
Yeah. Let me. Can I post something in this advanced webinar channel? I really want to highlight this,
Oh yeah,
if
sure.
that's possible. Yeah. So I
Uh,
want to take the screenshot here.
Yeah, there's a advanced webinar text channel as well. If you scroll up,
Okay.
quite a
Okay.
bit, but wherever you're comfortable to put it.
I just see the advanced webinar channel
There
here.
you go. Yep, that's it.
Okay. Cool. All right. So that white line right there is the low of the day for ES. So that's what kept me from playing that breakdown trade right there in puts, and we just bottom wicked right off of it to the penny, and that happens all the time. So it's so important to identify pivot levels in the market, whether it be the prior day's highs and lows and the pre-market highs and lows. So that, and I mean pre-market on ES, because that, like, again, that takes into account the whole market, because that tells you, that the computers stop it there for a reason, and it's not just random. It's because their rules are set to stop right there or bounce it right there, and that's what happened. And plotting those allows me to be safe in those environments. People get caught up in the selling off and think, oh, I need to jump in puts here. Well, it's like I'm saying, we're coming up on pre-market lows. I'm not buying puts. I mean, you're going into a wood chipper right there trying to buy puts, and we bounce right off of it. So sorry, I didn't mean to cut you off. I wanted to highlight that particular area.
Oh no, not at all. That's excellent.
So your question was, how did I evolve into an option trader? Is that what you're saying?
Well, into or do you or did you play all sorts of different strategies with options because the flexibility is tremendous.
Yes, absolutely. So over the years, I started out trading and day trading and scalping stocks on a margin account trading those, and then obviously I did the natural progression into options, and then from the options to different strategies like short spreads, iron condors, etc. So for me, primarily right now, I'm only doing long options in spreads, even less spreads now, because I think spreads are very, very volatile. It's very risky in this environment. Anyone who done spreads know that you need to be very cautious, and you know what you're doing with trading spreads in this volatile market. But yeah, I primarily, in terms of other strategies, I do debit spreads, credit spreads, iron condors, those type of things. I've dabbled in selling cover calls off of my long term portfolio, but I don't do that much now. I kind of want to do a hands off, and I primarily stick to long options and credit spreads.
Okay, thank you.
Less credit spreads. Like I pretty much stopped doing credit spreads a lot. I was doing a lot per daily spreads, multiple, up until about February. And then it got to the point where I got tired of 100-point moves and defending credit spreads aggressively. So I just like, man, I'm just going to put those on the back burner until the volatility comes off. And then right now, just take advantage of directional plays with these crazy moves and the long options, and that's sufficient.
Yeah, that makes good sense. I'm just kind of curious also too about some of the volatility plays. Like, we knew there's going to be some action at FOMC or the days coming up to it. Uh, are you in those positions playing the implied volatility? A week in advance or a few days in advance, etc.
Yes. So what I've kind of done, and I've refined this down over the past 6 or 7 FOMCs and CPIs, is I've really started taking advantage of strangles, long strangles, which is not something I normally do because to me that it's too risky to take a hit on theta. But it's pretty much been free money for CPI and FOMC. And we kind of this time we did a little bit differently. Like I noticed that For some reason, IV does not spike that much on CPI, but it spikes an incredibly amount on FOMC. So I thought, well, if I could take a strangle the day before an FOMC and take advantage of the IV pump, it's pretty much a free trade on a strangle. And it's beautiful because, like, on yesterday, 2 days ago, on Tuesday night, I placed I placed a 30 outside the money strangle on the SPX, and I woke up the next day and the call was very profitable, and the put was still pretty reasonable given that we were up 40 points on the day because IV had spiked over 110%. It went from like 38, 40% up to 80 something percent, and it bolstered the premiums. So that allows me to pretty much take a free trade. And I closed the calls at the top. We sold off. I sold the puts at the bottom, and it was a beautiful trade because in a normal environment, if you swing a strangle overnight, the worst thing that can happen to you is the market opens flat, and you'll be down like 56% right off the bell. But watching that IV and being privy to the IV go from 41% to 80% and then eventually 150%, the premiums are being supported. So I can take a trade. I can take a strangle. Worst case scenario, the market's going to open flat and I'm only down like 12% because IV has popped so aggressively. Best case scenario, the market's moved and it's free money. So the risk reward there is incredibly good. And again, that doesn't happen very often with long strangles because, again, long strangles are very difficult to manage when you open flat. But to me, it's a free trade, and yesterday paid off very well. And we're able to to pinpoint the tops and bottoms of that volatility. But another obvious way to take advantage of that high volatility is to sell positions, sell options into that implied volatility to get the premium pump. I elected not to do that this time because literally, I mean, you saw we had 100 and something point drop, and when you're dealing with 120 point moves, that's you need to know what you're doing, and you need to have a good foresight and capital to defend your credit spread. So I didn't sell any position into that. We will kind of get into selling iron condors and spreads on earnings events when IV is that high. But in terms of this move, I don't want to touch short positions in this market with huge potential for moves.
Yeah, makes sense. No, that's awesome. It's great to hear. Now, just to verify it, you mean a strangle as in you're selling calls and puts, or a straddle where you're buying calls and puts before?
Long strangle. So I'm buying a call and a put. So my normal thesis or my normal strategy for a day like FOMC or CPI is to buy a call and a put that's both 30 points outside the money, and that allows me to take advantage of those big swings. And it's worked out. Sometimes we've had a 540% win, sometimes as low as like 100%. Sometimes, like yesterday, was only like a 25% win. But either way, it's free money. CPI and FOMC it's literally paid off every time, and it takes advantage of that IV pump.
Yeah.
Yesterday, like I said, I took it the day before because I wanted to take advantage of that IV pump and kind of get a free trade, and it worked out pretty well.
Yeah. Are you doing any kind of delta neutral hedging on that, or?
Yes and no. I'm always like, what I did yesterday is I rolled up the deltas. So when the market opened and SPY or the ES was up like 40 points, I closed the call, which was already in the money, and I rolled up the deltas up to a call that was about 20, 30 points out to try to hedge against that position. And obviously we sold back off, and I was able to make money on the puts, but still a net profitable on the position. But yeah, that's a great question. So that's a little more advanced on the strangle strategy because a lot of people understand the buying and selling, but they don't understand the hedging part of things. So that's exactly what I did. If one of the positions go on the money, I'll close out that long leg that's in the money and roll up the deltas up a little, maybe 30, 40 points higher, depending on it. I'll only do that if on a volatile day such as FOMC, where I think there's a pretty good chance we could make those type of moves. But
this is just great. I mean, all sorts of things that you're doing here, and then looking at the liquidity here with your your day trading and putting all of this together into your strategies for your options trading.
For sure, yeah. I've kind of refined it down to the minimal amount I need to be the max effective, because I am a big proponent of less is more. I want less stuff on my screens. So it's like right now I've got it down to SR levels and then some EMAs for trend days, and then of course Bookmap, and that's it. More than that, I'm going to start to get conflicting ideas. I'm going to start to get some like oversaturation of indicators, and you don't want that. But yeah, it works well. I've got a very intentional watch list because it allows me to conduct a litmus test of the market at any given time. It allows me to monitor any kind of price changes or divergences, and then of course I've got my tools to monitor order flow and liquidity, and it's a good setup.
Yeah, beautiful stuff.
So now I'm seeing we got another test. Here's a second test of pre-market lows, which is going to be less confident than the first one because the first one obviously came down and touched the demand first time. We had a very aggressive demand because we bounced off of it aggressively. The second one shouldn't be as strong. If we do bounce off of it, the bounce won't be as aggressive. I'm anticipating, and we could even have faced a breach. So the CVDs are very negative at the moment. And of course, we've got building on 3760, and they've actually cut 3750 a little bit, but still very high. And if you see, they're actually managing liquidity even further south too, 3740, 3725, and that order book is continuing to build lower. So this will be an important test right here. This will be an important test of this pre-market level. There's that first breach below and a bottom wick above. So there's still some demand there. There's still demand resting right under this pre-market low that does not allowing the sellers to pretty much come through that level. And we very well may do that in the next 5-6 minutes. But for now, there's still a good amount of demand there, and they're still bottom wicking this, which is telling us that there's still some transactions that need to be taken care of, and we need to negotiate that before we transact lower. And here's that first test, 3767. So this is one of those times where obviously we're in a trend down morning, and I want to play trends a little bit more differently than a consolidation day because we get a trend up, trend down, and the market usually only trends about 20% of the time, and it consolidates about 80% of the time. I treat those days differently. For here, if this was a consolidation day, I wouldn't even be necessarily looking at puts right now. I'd be looking for a bounce on calls. The fact that we are in a trend down, I'm going to give some weight to looking at a put here, 3750 put, which is just slightly outside the money. Because on a trend down, there's a higher chance that we're going to breach this and break down. Whereas normally, like I said, in a consolidation, I'm looking for a bounce here. Pre-market lows is a huge level. If we take this out, I would give a very high probability that we're going to transact 3750. Also, I've got a very large level, and I've plot two different types of levels. I plot my daily SR levels, which you see on the screen, and then I plot weekly levels that don't change. They stay there Monday through Friday, and I update them every Sunday night. And we're coming up on that level, which does happen to be right at 3750, which is great for me because when I have multiple points of correlation across the market on indicators that are independent of each other, that gives me a higher rate of confidence. And right now I've got my level, which is right 3747 that I calculated last Sunday. And then I've got Bookmap is showing a very large amount of liquidity posted at 3750. Not to mention it's only 16 points out here. So if we can take out pre-market lows under decent confidence with a good amount of volume, then I'll be looking for a decent chance we touch 3750, at which point I don't necessarily think we're going too much lower than 3750. But of course, then we'll see what happens when we get down there.
I'm wondering if, since in your intro there, you say that you're a volume price analysis options trader. Um, what exactly do you mean by that, or how are you using that in your day trading here?
Good question. Yeah, so there's a book that I read years ago. I was looking for something a little more technical in EMAs because I noticed that EMAs were fleeting. They were only accurate about 60% of the time. And I came across a book called The Complete Guide to Volume Price Analysis by Anna Coling. And she dives into a great relationship between volume and price action, where you can have price action, but if you don't have the volume to validate that, then it's a weak move. And then, of course, if you do have volume validating a price action, then you can determine an entry and exit based on some level of confidence. But the second thing she really touched on that was great for me is the hows and whys of volume and price action. So especially it's been very unique to experience 2021 and 2022, which is a very heavily news manipulated environment. Because everyone's like, well, why is the market going up? CPI just posted 9.1%. Or why is the market going down? There's really good news. Bad news is good news is bad news type of argument. And people get kind of wrapped up around the axle on determining good news and translating that, when really all it comes down to is accumulation and distribution. And it's based on the volume, monitoring the volume, because we know that the big players need to be at least net. They need to be net positive delta. So if they're going to try to buy low and move the market higher, I need to know when they're wanting to do that. So they're going to manipulate the market to bid the market lower based on any kind of news, and they're going to bounce it and try to transact that higher. And I think they utilize news to do that, and she kind of touches on that in that book as well. But overall, it's just basically monitoring the volume on the daily chart, weekly chart, even on down to the 3-minute chart to tell me where the confidence in the market. When are they going to start buying up low and selling high? And it works on all time frames. There's cycles in the short time frame, there's cycles in the long time frame where volume enters and leaves the market in ebbs and flows. And it really tells me what it's going to do. And it's kind of just based on that. I like to monitor that, and it really helps to cut out the noise of the news and see what cycle we're in. Nice little move down here. We got breached through 37.64.
So the volume price analysis is basically, I mean, do you look at it on lower time frames or higher time frames or both?
All of them. I'd give more precedence to the weekly and daily. Those are my two big charts I do my analysis on, and then obviously I kind of trim it out. And I kind of relate it to if you're going to sand a piece of wood to a good finish, you need to start out with a wider grit and go all the way down to a extremely fine grit to get that really smooth finish. And I kind of do it the same way. I go big to small. So I start out my VPA analysis on volume and price action based on the weekly chart, and then I go down to the daily chart, and then I go down to the 60-minute, 30-minute, 50-minute, all the way down to the 3-minute. And that gives me a good big to small. I'm funneling big to small. And that's going to tell me the fine print outside of what the really market is really trying to say, because I don't want to get caught up doing a macro analysis on a 3-minute chart, because that's not going to tell me the big picture. I want to see the big picture, and that's going to tell me on the weekly chart. And if you saw back, even up to applying this to yesterday before FOMC printed, we had a very large candle on the daily and weekly. And then the next candle on the daily and weekly was a doji candle, which tells me that's a bearish setup. That tells me that the bulls were not able to complete the deal on the bounce off of the weakness. So that's a bearish setup where I'm looking for a continuation down. And plus the volume wasn't there to support that a buyer's bounce either. Then of course we get the FOMC come in and they sold it off an additional 100 and something points. So managing where the volume comes into the market relative to the price action is going to give you a gauge of sentiment or confidence based on the big hitters. The big hitters are going to be able to tell you, well, hey, we want to start accumulating shares here so we can move it up 500 points and then dump them. And they're going to manage the fear, whether it be fear of missing out or fear of this market selling off, to move that market with volume. So that's why some days you get those huge 4% double sell-off days where it's this absolute institutional dumping, and some days we kind of consolidate and then we move up higher, is because you have to monitor that volume to see what the big money institutions are doing.
Yeah, that's fantastic. I'm wondering how you're reading it in Bookmap with the volume and price action, because I feel like one of the nice things in the way that we show that is it's on the chart, it's in the subchart there as your bar volume bars, and you also have CVD, but you're getting actual price structure and action together with exactly where that volume is transacting. It's very different than looking at it like a daily bar or a weekly bar and then the bar of volume based on that entire day.
100%, yeah, and it's because I think I'm very well a believer that the support and resistance of the market are evident if you know where to look. And I think the order chain and I think the liquidity book is going to pin where those historical supplies and demands are. I mean, if you look, I've got, I'll show you this too in the advanced webinar channel here. I'm sure my members are going to hate me for it because this is some of their data, but I want to show you all this just for the purpose of teaching that the prior chart, where's this advanced webinar? There we go. All right, so that big red line there is 37.47.50, and I post that Sunday night. And then we come to find out that the largest level of liquidity on Bookmap is 37.50. So that tells me that the market is correlating the very strong level that I calculated on 37.47, and all that is based on is prior support levels throughout the past year and a half. And the market has a memory. It's going to bounce at strong levels of support. It's going to reject strong levels of supply. And the Bookmap correlating that tells me that the liquidity book is definitely showing that liquidity and order book is going to support that level. So that to me is a high confidence area, and it's probably today's target as well. And I don't expect them. I probably wouldn't look them to break that level at least until the last 30 minutes of the day. The last 30 minutes of the day is a wild west. Nothing matters in the last 30 minutes of the day. But that order book right there is really showing me that there is a high confidence at 37.40, and I need to pay attention to that. But yeah, that's I'm looking at the Bookmap to validate the liquidity that's been placed historically and the potential liquidity that coming in on the market. And if I can correlate that through strong levels of supply and resistance in the market, then it's going to give me a great indication of where I need to buy and where I need to sell.
That's fantastic to hear, because we may have to have some other maybe events just on that subject with you. That'd be fantastic because I think what a lot of players or traders, when they start looking at Bookmap, they get very confused by liquidity. They haven't had access to liquidity before. None of the trading books, none of the education out there it talks about liquidity and understanding it. They understand volume really well, but they don't understand the other side, the liquidity. So it's really great to see how you're integrating that within your analysis.
100%, yeah, 100%. And people always ask me what value do I get at a Bookmap because they know that I'm very much heavily against indicators. And they ask me, what do I get out of Bookmap? And it's precisely that. It allows me to kind of interpret the dance between volume and price action. If I have a level on my chart that's not really showing up a lot of liquidity on Bookmap, then I need to be skeptical of that level because the market is the market. And if there's no liquidity there, then why would I expect a strong bounce there? Or why would I expect the market to transact up or down to a level of liquidity that's not necessarily correlated through the book? So if I can see that come on there, especially at a particular level that I've already calculated, I'm like, man, that's a good level, and that kind of correlates and affirms what I'm seeing here on the charts.
Since I've got you here, and bend your ear one more time on a question here about the implied volatility into heavy liquidity. Do those look like a kind of a no-brainer setup for you, or like how do you kind of read that? I've always thought this would be such a beautiful setup in the options. So
Yeah. So when
price cratering down,
Mhm.
into high liquidity, and they're just continually absorbing it, just looking for the volume to just kind of turn around a bit.
Beautiful. Yeah, that to me is one of the best things I love about using this. Is that right there? Is that, for example, if we're on a trend down day, which it definitely seems like we are now, I see 37.50 being built. I see 37.60 being built even stronger as we're coming on down. And the two big things to note is that I'm not seeing any order flow being built above, and I'm seeing not much else being built below 37.50. We do have some being built down to 37.25, but that may change as we get lower. But basically, what I'm trying to look for on a trend down day is when are they going to stop selling and either one, enter into consolidation, or two, bounce this back up into another supply. And managing the Bookmap here, if I could see that one, they're not really adjusting the liquidity below 37.50, then we may be looking at the bottom of the market either at or slightly above 37.50. In my trading in the Discord server, I kind of call that dangling the carrot. When we start approaching 37.50 and I see people starting to look for more and more puts, I'm just saying be careful of the dangle of the carrot, because they're going to dangle that carrot right at or under 37.50. They're going to get people FOMOing into puts, and then they're going to bounce it back up. That's how they get that aggressive move. So when I see a large amount of liquidity, such as 37.50, and not really much else, then I'm looking for more of a consolidation / bounce play at 37.50 as opposed to a wipe liquidation and fall through. Granted, there's a lot more variables to it, and it's definitely dynamic, but that's pretty much the overall theme. I'm going to be more skeptical of puts at 37.50 as opposed to taking calls.
Yeah. I mean, that you're just going to get such a discount on your options at that point.
Oh yeah. Yeah, that's the thing. You want to, the VPA book I talked about talks about a great setup for that. Is when you start looking, instead of, you have to think about it. You have to think about how the institutions are thinking, not about how retail thinks. Retail is looking at buying as cheaply as possible and selling as high as possible, whereas the retail trader is looking for the move. They want confidence in a move. So when you see a big bullish move forming, the move could already be 70% done. Now retail is trying to look at buying, whereas institutions are looking at selling. So I want to buy into weakness as low as price as possible and sell into strength. Whereas retail is kind of different. They want to buy into they want to short the shit. They want to like buy puts or short the market into weakness to take advantage of the confirmation. Whereas institutions are thinking of countering that move. So when I see large areas of liquidity, I want to start looking where do I have an opportunity to buy into this weakness? And if the market's raging up high, do I have an opportunity to close out or short into that strength? Now, obviously, you got to be delicate and do that very precisely, and that could be on the weekly chart or on the daily. But it really depends. And me knowing the VPA and the system as well as where the liquidity is printed on Bookmap allows me to kind of refine that process. So there's a nice little strong green bounce off S5 right there as we're kind of coming on down. And this is kind of what I was talking about. The closer we get to 3750, we may see more and more of these type of little bounces as we start to enter a little bit lower. We start to face more and more demand and maybe one more aggressive flush down. But overall, you got to be wary of the dangle and the carrot. They're going to try to get you down and start FOMOing into puts or shorting stocks, and then they're going to squeeze people out. And you just got to be careful coming on down here. So we got 3767. That's a little 10-point bounce right off S5 there. So that's about the second strongest bounce we've had today, and that was the first one off of about 10 o'clock in the morning. We had a bounce off of 3772 up to 3795. But if that's what I'm looking at from here on out in terms of Bookmap is how they're going to manage this current liquidity right here. Are they going to start adding a little bit more to the book higher to kind of skew it a little bit, or is it going to maintain this level here? I'm looking for, I don't know, at this point, is there a potential for a V recovery, or are we going to continue on down? So far, that's a pretty strong bounce right there. And how is the volume going to react right now? Not too much volume coming in so far, although it's starting to increase and build, and we're already right up to the 34 EMA in S3.
So there's a question here in YouTube. I was just about to I answered it already, but I hadn't sent it, and I thought, well, no, I better ask. Where the liquidity is where price is most likely to go?
Well, it depends. It depends. If I don't necessarily look at them alone as targets, I'm trying to look at how is the overall liquidity being managed in the book? Is it skewed heavily to the south or up to the upside? Do we have an outlier that I necessarily need to be looking at? So it is a target in a way, but it's more about the management of the overall liquidity of the entire book that's really going to drive sentiment for me. If I could see continuing sentiment being put on or liquidity being put on lower and lower, and they're continuing to shift that liquidity lower, that tells me that the market is going to try to bid the market down potentially. And that's what I want to look at. In terms of this, if we're going to look specifically at this particular setup, I think 3750 or plus or minus, 3750 plus or minus 6-7 points would be a great target for the day. Just judging by what I'm seeing here. I've got 3760, 3750. And not really much else here. Obviously, they're putting on stuff lower, but the big stuff is right there. That's been on there all week. And the fact that it has been on there all week and they've built that into today can tell me that 3750 is a likely target for late this morning or early afternoon, somewhere in there.
Yeah, that's kind of what I had loaded up was it depends was the answer, but good to hear.
Yeah, it depends. Yeah, that's the thing about options trading or trading in general. It depends is pretty much the answer for everything. Unfortunately, it's pretty dynamic.
So Steve is also asking, what if there's liquidity on both sides? How do you read it?
Yeah, so when we're straddled with liquidity like that, it again, it depends obviously, but what I'm looking for is how's the skew really showing? Is it balanced, completely balanced? Then I'm looking for maybe even a consolidation day where it bounce off lows, rejection off highs. If it's 80% downside, 20% upside, then maybe a slight retracement up to that liquidity and then a move on back down. But it honestly depends on how skewed the order book is. How is it balanced? Then you're most likely to see a lighter liquidity environment, balanced order flow here on a consolidation day, and that's where the days where I want to scalp low and high. Whereas a trend day, we may see it completely skewed to the downside and not very much else to the upside, which is what we're seeing here today.
So basically, the play for you is like, take what the market gives you.
100%, 100%. Taking the market it gives you, and it's more difficult the tighter time frame you get, and the longer time frame you get, it's easier for me, but you have to be more patient. And unfortunately, that's not something a lot of people are able to do. You got to wait for the trade to come to you. My best trades are the ones where I kind of get that spidey sense, where like I get I'm completely calm taking the trade. I have no stress, and those are usually my best trades because I'm patient enough to wait for the trade to come to me. If I'm going to take a call or put a specific point, I have to be very disciplined to wait 3, 4, 5 days for that price to approach that point and enter the trade at that point. So the longer time frames, yeah, absolutely, and the shorter time frames, obviously a little more on a just reduced time scale.
Okay, everybody. Well, the webinar is being recorded here, and it will be up on YouTube later. So just let you know, Peter.
Yeah, great question though, man. I love talking about this stuff. I mean, my members know I can get pretty long-winded talk about anything from anywhere from VPA to price action to emotional, like everything. Like it's a subject I'm very passionate about because especially with the huge influx of investors the past 2 years, I think there's a lot of misconceptions about what day trading or investing in general actually is. Some people treat it as a casino, some people treat it as gambling, and it's definitely not. And the second you treat it like that, you'll learn quickly that it is not that. So I'm very passionate about the subject and trying to refine, always trying to grind that axe and refine the process and try to really be patient on the entries and calculate exactly when to enter. And it's never ending process. It's never perfection. What was that right there? So we still got that 3760 on. We kind of trucked up here to 75. As volume starting to enter here, we have more and more buy volume starting to enter the flow here. We have some iceberg coming on here too. That was kind of light earlier.